Welcome everyone to the Direct Advisors video podcast series. My name is Stacy Gregory. I'm a plan advisor with Direct Advisors, and I'm joined today by Mike Kiley and Karl Willman of Nyhart. And we're going to talk a little bit about the benefits of using a cash balance pension in addition to a defined contribution plan, like a 401k, for example. And that's to really better maximize the use of employee fringe benefit dollars. So Mike and Karl, thank you both for joining me today. And if you guys
Thank you, Stacy.
Yeah, of course. If you guys wouldn't mind maybe each taking a moment to just kind of introduce yourselves and talk a little bit about what you do at Nyhart.
Absolutely. I'll go ahead and start first. This is Mike Kiley, and I've been a consultant with Nyhart, been with Nyhart for about 18 years. Been in the industry for a little over 25 years, but I'm also the relationship manager with Direct Advisors. I handle mostly defined contribution plan consulting and new business development. So Karl will be handling a lot of discussion today on cash balance plans, but I'll be joining in and adding some comments where necessary.
Yeah, thanks. I'm Karl. I'm an actuary here at Nyhart, and I've been here for a little over 12 years now. I manage a team that handles about 500 of these small employer defined benefit and cash balance plans. So that's about it, and hopefully we have a good discussion here.
I'm sure we will. Thank you both. So I kind of wanted to start with just kind of an overview of what a cash balance plan is, because a lot of our clients are familiar with defined contribution plans. You know, they all have either a 401k, a 403b, a simple plan, but they're less familiar with defined benefit plans. So what is a cash balance plan? How does it work?
Yeah, a cash balance plan is a type of defined benefit plan. So you think of a traditional pension plan that somebody's going to work for a company for a long time and receive a monthly annuity when they retire. This is the same concept and the same rules and regulations from the IRS, but it looks and feels more like a 401k. So it's easier for everybody to understand when they have an account balance, but it is still an employer provided benefit. So the money is all employer contributions. There's no employee deferrals in this plan. That's all employer money. The interest, the benefit is, again, it's defined because that's the nature of a defined benefit. There's also a defined interest crediting rate. So, you know, participants don't really care if the investments go up or down. Their benefit is described in the document. It'll go up by some specified rate. But most of our plans are set up at a fixed rate of, 3 or 4 or 5%. So that's kind of the main difference is it's in the name, right? It is a defined benefit compared to a defined contribution plan. We're defining what we're going to put into it, and then it can grow or lose money. At the end of the day, you get what's out in the account. The defined benefit plan, you know exactly what your benefit will be, and it's the employer's obligation then to fund that amount.
Very good, very interesting. And I know with the 401k, those dollars are subject to vesting, they're portable. How does that work with the cash balance plan?
Yeah, same kind of concepts. The vesting schedule may be a little different than what you're used to at the 401k. In the cash balance plan, the money has to be fully vested after 3 years of service. So 3-year cliff where you get 0% vested until you've been there for 3 years is the most common thing. But it certainly could be more generous than that. It is fully portable, just like any other qualified retirement plan. So when somebody leaves employment or the plan terminates, that money can then be rolled into an IRA or another 401k, or of course you can always just take it and pay income taxes and whatever penalties associated with the early distributions.
Very good. I know you mentioned the annuity payment there as an option, Karl. Do they also have the option to do a lump sum payment if they choose?
Yeah, that is the most common. Even in traditional defined benefit plans, where an annuity is the defined benefit, if a lump sum is an option, almost everybody wants to take that, right? If you get your chance to take that big sum of money, everybody wants that. In a cash balance plan, that is expected. Most people will take it because it is already is defined as an account balance. That's what they think they have. But because it is still a defined benefit plan, all those other optional forms of benefits that defined benefit plans have to offer are also available. So If somebody, leaves employment, we show them their package. They can take the lump sum, but they also have the option of maybe taking a life annuity or an annuity with a spousal survivor percentage as part of that. But, 99.9% of the time, they will just take the lump sum option and either roll it over or take it as income.
I see. Good to know. It's good for plan sponsors who want to offer that sort of flexibility to their employees, that they can offer that kind of guaranteed payment every month where people don't have to think about it, or they have that flexibility for the lump sum. So that's great. Do you find that employers are offering either just a defined contribution plan like the 401k or just this, cash balance defined benefit plan, or can they have both?
Yeah, typically they have both. The way we will design the plans in most cases is we are targeting the owners or a specific group of individuals to get significant retirement dollars. The main goal typically is additional retirement savings and additional tax savings above and beyond what you can do in your 401k plan. So with a 401k profit sharing plan, obviously, most you can get between your personal deferrals and the other employer contributions, safe harbor or profit sharing or match and all that stuff. Well, that maximum is about $57,000 plus catch-up deferrals if you're above age 50. A defined benefit plan or cash balance plan is usually layered on top to get significantly more. We can talk about some of those limits in a little bit, but most of the time we think of the cash balance plan as kind of the owner's plan, and we give them the bulk of their benefit there. Employees will have to benefit to some degree, but we might, we try to minimize what the employee cost is in that plan. The employees will get the bulk of their benefit in the 401k profit sharing plan. So on its own, the cash balance plan as designed is usually discriminatory, right? We're giving a lot of money to the ownership group and little to everybody else. So we're pairing that with the 401k, even though they're two separate plans. That we're aggregating them as if it's one big picture for the retirement program to show that between all pieces of the puzzle here, we are passing all the IRS testing rules.
Got it. Very interesting. Yeah, we have some clients currently that utilize the cash balance plan in addition to their retirement plan. And, like you were mentioning, there's a whole slew of reasons why that would be a benefit to plan sponsors. I think the most obvious benefit that you just touched on, Karl, is the tax savings. In addition to obviously the extra money that they're saving for their own retirement, currently we have clients who do a significant amount of prevailing wage work. And while some of these dollars are used towards the employee benefits, things like health insurance and vacation pay and supplemental unemployment, for example, we also have dollars being deferred to the retirement plan. But there are deductibility and contribution limits, like you mentioned, in the retirement plan. And so as a result, some employees are receiving cash payouts upwards of $10,000, $20,000, $30,000 each year, significant amounts of money. And those cash payouts are subject to employment taxes, including the FICA tax, which is currently 7.65%. So by redirecting some or all of those dollars to the cash balance plan, the plan sponsor can avoid those employment taxes. They can increase deductibility. They also fulfill their funding obligations with those dollars, which are huge wins for the employer. So utilizing those prevailing wage dollars in this cash balance plan has a lot of really big benefits. Something that we all talked about when we were kind of preparing for this meeting was how administration is also a lot easier in the cash balance plan when we compare it to something like the administration that's involved with a 401k plan. Plan sponsors aren't having to deal with managing loan repayments and hardship distributions. They don't have to update their deferral contributions every pay period or throughout the year. So it's much easier for them to run a plan like the cash balance than it is for something like the 401k, which does have a little bit more legwork involved. Are there any other areas of administration that you guys have found that have been easier for employers when we compare it to the 401k plan, or do you think maybe I touched on the big ones there?
Yeah, I think that those are the big ones. I think investments are another big portion of this. Because it's all employer money, there is no participant education or advising that has to go on. You just like the other plan, you give them the summary plan description, the SPD, that tells them they have a benefit in the plan and what it takes to earn a benefit. But beyond that, there's no investment choices for them. It is one pool of assets for the entire plan. And again, it's invested for the pool, so you take advantage of economies of scale there with large contributions all going into one account. So hopefully lower fees there. There's less management going on. And one of the fundamental differences too should make it easier on everybody is the risk you're taking with the investments as well. As I mentioned, you're usually targeting some 3 or 4 or 5% return in the investments. So you don't have to take a lot of risk in that plan. So it should make it easier for the advisor to also manage the investments there. So some people don't like that. It's very conservative, but you got to kind of think of it as the, I guess, conservative piece of the overall puzzle of their investment portfolio. There are some funding obligations in the cash balance plan. So if you take on more risk and get a huge return, that means you might not be able to put in as much money in following years, which of course then kind of negates some of those tax advantages. If you can't put in as much money in, you're paying taxes on that money. And on the flip side, if you take that risk for a large return and you perform poorly or lose money, as a defined benefit plan, you have to make that money up at some point. So again, that's another, obviously downside that might not work for the cash flow. If you set this up at a specific funding level, you want your contribution and your tax deductions to be predictable from year to year.
Sure. Yeah, all great points. And, as an investment advisor, we're constantly stressing the importance of diversification and balancing that risk, that you're taking on in your portfolio over time. And since a lot of these plan sponsors and employees already have access to a 401k where they can be as aggressive or conservative as they'd like, it's nice to have this cash balance as a second component that they don't have to spend much time thinking about, and they can really focus on growing their retirement savings in that defined contribution plan with the 401k. Yeah, all great points. Thank you. And, on top of the diversification and the employer savings that we just touched on, the employees are receiving somewhat of a supercharged retirement savings with this cash balance plan. I know a lot of employers and plan sponsors that we work with are finding that employees are either tapping their retirement plans early for emergencies, or they just simply don't have enough saved. They're underfunded come retirement time. And so the cash balance plan is a way to help ensure that those dollars are available to them at retirement when they need them. These dollars can't be borrowed against. They still grow tax deferred, so they benefit from that compounding growth like the dollars in their retirement plans with the 401k. And they have the option of receiving, like we said, those annuity payments or a lump sum when the time comes. So having both a fixed stream of income in that cash balance plan and then access to those larger lump sums of money and everything growing tax deferred is a huge benefit. And it really helps offer a lot of security and flexibility for the employees. And then it helps those plan sponsors prepare these employees for the transition to retirement when the time comes. One of the things that you had just kind of touched on there a moment ago, Karl, was funding, and whether funding is discretionary or mandatory, how much money can go in. Can you touch a little bit on the dollars that are entering the plan and kind of how that works?
Absolutely. Yeah, the dollars that go into the plan are kind of decided upon up front. The plan document will be specific as far as what the allocation is in the plan every year, and whatever it is, a benefit will grow by. The limits are quite large. That's kind of the advantage here compared to the 401k, that depending on your age, you may be able to put away 2, 3, or 4 times more in the cash balance plan than you can adjust the 401k. So, a 55-year-old, for example, business owner might be able to put away an additional $200,000 or more into a cash balance plan for their own benefit, in addition to what they're doing in the 401k. So limits are kind of dependent on age, but you don't have to choose that amount. Obviously, that's just the maximum potential. So we'll set the plan up as whatever level works for their cash flow needs and their tax deduction needs. So it's always best to have, obviously, the advisor, the CPA as well on board to make sure they need the tax deduction, of course, and what that benefit level is. But once the plan is up and running, the intention is you will fund that allocation level every year. In that example, I said 200,000. As a defined benefit plan, there may be a minimum required contribution that has to go into the plan that's a little less than that. There may be a maximum deductible contribution that's larger than that amount. But for the most part, they'll put in that allocation total every year. But yeah, as a defined benefit plan, there are required contributions by the IRS. And if you don't meet that, there's taxes and penalties associated with that. So It is something you have to be a little more forward planning with in the 401k. Since there's required contributions, you kind of have to plan more like a year in advance as far as to what that benefit's going to be. And it's not something the IRS wants you changing much every year. They don't want you opting in and opting out, funding it one year, not funding it the next year. So, kind of set a benefit level that you're comfortable with for a few years, and then you can reevaluate it a few years down the line.
Good, thank you. That was really helpful. So I think kind of to recap a lot of what we just touched on, the huge opportunity here is, for plan sponsors, one, to be able to save much more for their own retirement than they could in something just like the, traditional defined contribution plans like the 401k. To save a significant amount more towards their own retirement is obviously beneficial, but also that tax savings that they're receiving on the employment taxes, and the ability to save FICA and additional taxes. And then, the last one that I didn't really touch on, but I do think it's important to mention, is employee retention, and using this as a tool to attract employees to your company. To offer this as an additional benefit is seen positively by, potential employees. So to use this as an employee retention tool and to assist with retirement readiness is also really huge. I think that touches on really the main points that I was hoping to cover. Mike, Carl, anything else that you guys think might be important to address here today?
Yeah, I'll throw out one thing real quick, Stacy, and thanks. And that was a great recap of that. So one thing I will say is that, whenever we're talking to folks that are interested in looking at a cash balance design along with a 401k, it really, it makes a lot of sense. And there's not really a lot of onus on them, because of the fact that we can run a contribution illustration for them to show them really what that amount can be that they could put into a cash balance plan, and they can do their planning from there, and we can have further discussion at that point. So something really just to be able to kind of wet the whistle, I guess, and give them a good idea how much they could be able to put into a cash balance plan. Again, we could run that free illustration for them.
That's really helpful. I think a lot of people will be really interested in taking advantage of that. So for anyone watching that is interested in learning more about the cash balance plan and how it could potentially benefit you and your company, certainly don't hesitate to reach out to myself. I can be reached at the Direct Advisors direct phone, which is 518-362-2119, or our email address, so info@directadvisors.com. Mike, Carl, thank you again so much for taking the time today. Everything that you guys shared was really helpful, and I know we'll be in touch again soon.
Thank you.
Thank you, Stacy. Appreciate it.
Guys, take care.
Thank you.